if you add 1% Bitcoin, not even a lot, 1% to a portfolio, your return per unit of risk goes up about 20%.
Wow.
200 basis points compounded per year. Now, and I'm even excluding the first 4 years. To me, the first 4 years don't really count from kind of 2009, 2013, because it was sub a penny and it was tiny and you couldn't put any real money in it. But starting in 2013, you could put real money in it. Even using that data, you get wildly accretive results. So people are finally given in to this idea. And those are people who want to own it.
Mark Yusko often compares Bitcoin to gold as a way to explain its role in the financial system. At first, they might seem completely different. While Bitcoin is still relatively young, gold has been trusted for thousands of years. However, when you examine their actual actions, they are fairly comparable, because to their limited quantity, neither can be produced indefinitely. Both function independently of the government and are frequently employed by investors to safeguard their capital in the event that currencies depreciate. Over time, their performance has also shown some interesting similarities. There are years when Bitcoin rises much faster and other times when gold performs better. But over the long run, they often move in similar directions, especially when investors are looking for safety during periods of inflation or economic uncertainty.
I actually didn't get many surprises. I mean, the precision of the prediction by the guy who said it was going to be exactly on October 6th. Okay, that was surprising.
Yeah, that's impressive.
But it was supposed to be sometime in October because it's not 4 years. It's 3 years, 11 months. I call it the 3.11 cycle. That it's based on the number of blocks. It's not a calendar 4-year cycle. And so people just missed that. And it was December in 17, and then it was November in 21, and it was shockingly October in 25. So that played out exactly. But the biggest thing for me was the difference in the ebullience in this cycle. So the one thing that surprised me is in normal cycles, normal being, we only have really 3, this is the 4th, is we get there. Let me back up. So there are 4 types of investors, or 4 types of market participants. Investors, people who buy things below their fair value, right? You can buy $1 for 70 cents. It's a pretty good deal. Value investors like me, we like to do that. As those people start to buy, the price starts to move. And that's what we refer to as kind of crypto spring, crypto summer, right? People are buying stuff knowing that it's trading below fair value, but someday it'll go up. And that starts to move the price. Well, as the price starts to move, traders come in because traders need price movement. You know, it's like that meme with the thing, poking the thing with the stick, just do something. If the price doesn't move, trader can't make any money. So as it starts to move, the traders come in, and I have nothing against traders. I stink at it, so I don't do it, but it's hard. Being a trader is hard. But if you have skill, like, you have some partners at UTXO, they're pretty good at it. It's just hard. So traders are fine. There's no good or bad. Well, then the speculators come in. Now, everyone thinks speculator is evil. Well, speculators are not bad. Speculator is just a term, and all it means is the opposite of a hedger. Well, what's a hedger? A hedger is someone who produces something that needs to sell it to pay bills. Oil producers, gold producers, copper producers, Bitcoin miners. Well, what do? They sell forward. They sell their production in the futures market. Well, someone has to take the other side. I love when people say, oh, there's more buyers than sellers, or there's more sellers than buyers. No, there's not. There's exactly the same number every single day. So yeah, the marginal person putting the offer or the bid out is a buyer or seller, but they're always the same number. And so when a hedger sells their production, a speculator who has no real view or they're just speculating, right? They're buying the other side of the hedge. Now, they buy as it gets above fair value, and it starts to push above fair value. Because if you're a hedger, if it's trading below your cost of production, you're not going to sell. It's kind of like why, and I don't want to jinx it, but Bitcoin has never in 17 plus years traded below the cost of electricity, which makes perfect sense, right? If I have to pay for the electricity, why would I sell it until it's higher than that? Mm-hmm. So as the price moves above fair value, they start to sell, the speculators come in. If you just don't look at the last 9 months and you look at the last 3 years, Bitcoin and gold have exactly the same return. If you back up 5 years, Bitcoin's ahead. Back up 7, 9, they're the same. So why is that? Because they're the same thing. An ounce of gold is an ounce of gold, 1 Bitcoin is 1 Bitcoin. They're the same. What matters is the fluctuation of the fiat that you buy it with. But gold went up and Bitcoin went down. Yeah. And in 21 to 23, Bitcoin went up and gold was flat. So what happens is the spoofing, right? They were on gold for 2 years and they lost control. They were on silver for 5 years. I mean, silver was like, $20, $30 for 5 years. And then boom, they just lost control. And arguably, JP Morgan, there was a rumor they were bankrupt, right? Because they were 2 times short all the world's silver. They got caught short gold, which is why the GLD got introduced. So this happens. And now all the trade is on the short Bitcoin side. And there was a reason they attacked gold. I told you, right? They didn't want gold to go up because that tells the masses that they're being stolen from. You got to zoom out, first of all. Second of all, the correlation of any store of value to each other is going to be episodic because of this futures market. But over long terms, they're going to be very highly correlated. And that actually does show up in the data. The real problem is, that's not a problem, but the difference is the vast majority of people, they already have their belief.
Every few years, the same question comes back to investors. Are markets becoming more stable, or are we still stuck in the same boom and bust cycles? With more institutional money, hedge funds, and big players entering the space, many believe the old patterns should be fading away. But veteran investor Mark Yusko sees things very differently. According to him, cycles are not only still alive, they are a natural part of how markets work. In fact, he believes that what we're seeing today is just another version of the same patterns that have repeated for decades, especially in assets like Bitcoin and other risk markets. While many are trying to predict a new era, Yusko argues that human behavior, greed, and fear haven't changed at all. Please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this.
If you add 1% Bitcoin, not even a lot, 1% to a portfolio, your return per unit of risk goes up about 20%.
Wow.
Make 200 basis points compounded per year. Now, and I'm even excluding the first 4 years. To me, the first 4 years don't really count from kind of 2009, 2013, because it was sub a penny and it was tiny and you couldn't put any real money in it. But starting in 2013, you could put real money in it. Even using that data, you get wildly accretive results. So people are finally given in to this idea. And those are people who want to own it forever as a diversifier for the portfolio. But they're going to buy 0.5%, 1%, 2%. Okay, great. Well, what we all hope is that other big institutions that have more money than individuals will do the same thing. Harvard, a few others have. Okay, that's good. That's all good. So then what's happening? Well, again, those buyers are doing exactly what you described, right? The key question, why isn't the price reflecting this step function increase in demand for spot? Well, it is, because if you look at the history, right, we make higher highs and higher lows. It takes a while, and there's cyclicality to it, but we do make higher highs and higher lows. So that's an accumulation pattern over time. Well, what about sovereign wealth? What about the strategic Bitcoin reserve? We didn't get that, okay? So instead, we got the Genius Act, which is not as good as people think, and the Clarity Act, in its current form, bad, like super bad, like CBDC bad. So let's not have that. Brian, public enemy number one, I'm rooting for you. And what happened to Senator Lummis? I mean, she was on our side. Now she's fighting for this bill that is like Elizabeth Warren worthy, crazy. So all that is happening in real time, but up top, you still have, and I'll stop talking in a second, but we still have the powerful people who do not want this to happen, right? And we've all heard the quote, first they ignore you, then they laugh at you, then they fight you, then you win, right? Whether it was Nelson Mandela, I guess he stole it from someone else. I can't remember the guy's name. But 2009 to 2015, first they ignored you. No one cared about Bitcoin. Like, no one. I mean, a few people, but the average person couldn't even spell it, didn't know what it was. And like, yeah, nerds and geeks playing with their magic internet money, whatever. From 16 to 21, then they laugh at you. So now the nerds and geeks were real, and some of them were getting rich and doing fun stuff, but it's just still a bunch of nerds and geeks playing with magic internet money. Okay. Well, from 22, I think till 27, 28, that's the then they fight you phase. So we're right square in the middle of that. And it's everything from regulatory capture, which is what they're trying to do with regulations now. And we should be nervous about that and fight against it. Then you've got, the spoofing and the financialization. And you've also got the FUD wars. I mean, it's amazing how they just keep recycling the same crazy stories over and over again. And it's like, we've settled that. And I guess the thing that bothers me most, right, is, look, I'm not a techie. I'm not someone who really understands the code, and I'm not someone who grew up thinking that this was going to be my life's ambition. But, I'm a financial services guy, and I came to this and I studied it. And once I saw what it was, right? Once that I saw that it was a better form of money, you can't unsee that. In 2021, fair value was in the 30s. We got to 69. Okay. Then this time fair value was around 80-ish, 82. And we got to 120. So we got about 126. We got to about 50% higher instead of 100. So in theory, the drawdown should be lower, right? If you're 2 times fair value, you got to go down at least 50, but you never stop at fair value. You go right through it because people panic and they sell. And so we went down, 84, 83, 74. Well, this time, if we're only 150 above, we only got to go down 33 to get to fair value. Then we go through that, got down 51. Now, I'm not saying the bottom is absolutely in. To me, crypto winter lasts, about 11 and a half months. So that's sometime in September of this year.
Mark Yusko highlights that Bitcoin and gold have remarkably similar long-term performance when you zoom out. They have produced almost the same results over the last 3 years. When looking back 5 years, Bitcoin has a little advantage, but when looking back 7 or 9 years, they are essentially the same. This is because both are types of hard money. According to Yusko, 1 Bitcoin is always 1 Bitcoin, and an ounce of gold is always an ounce of gold. The actual variations in their short-term pricing are not caused by the assets themselves, but rather by changes in the fiat currency used to purchase them. Additionally, he describes how futures trading and market manipulation can produce transient distortions. Large institutions have intentionally depressed gold and silver in the past, and Bitcoin has seen similar short-term pressures. The long-term link between repositories of value is nonetheless significant in spite of these episodic distortions. Yusko emphasizes how the structure of the network, not a rigid schedule, drives the incredibly accurate market cycles in Bitcoin. In the end, he suggests paying more attention to the long-term signal than the short-term noise. Although markets can appear confused due to volatility, market distortions, and false data, the underlying patterns and fundamentals are always the same. Investors can navigate the market more confidently and steer clear of hype or fear by comprehending these cycles, participant kinds, and the idea of fair value.